Hello, I'm Greg Hunter. Welcome to USAWatchdog.com. Today we have back once again legendary trader Ira Harris, also legendary analyst. You have to be a good analyst to be a good trader. Ira is both those things. Ira, thanks for joining us today on USAWatchdog.com.
Greg, my pleasure. Thanks for having me.
Well, on your blog, Notes from the Underground, I love your buzz line where 2 plus 2 equals 5. You had some great stuff you wrote in analysis of the upcoming G20. You know, one Swiss banker says, well, there is no such thing as a currency war, when in fact we have a currency war. I mean, Jim Rickards, the great analyst and banker Jim Rickards wrote a big best-selling book about currency wars, that everybody was trying to devalue their currency. The Japanese are, overtly devaluing their currency. Abe has put in, somebody who will basically debase currency. What's going on with the upcoming G20 meeting and the quote-unquote currency wars that some people just don't acknowledge?
Well, they're real because the Japanese, let's go back to the Japanese. And you can go, for those who want to read my blog, actually I blogged on October 14th, after the last G20 IMF meetings, that there was a signal that the Japanese were given that it's okay for them to start pushing their currency lower. And you can, it's there in black and white, I'm not making up. And they've done exactly that because it took them a long time to realize there's a sucker at the table. Everybody is basically debasing their currency to get some type of advantage or to get their economies going. And they were the sucker at the table. And they said, no more of this. And then you had Abe get elected, but the currency started going down October 16th. You could see it because they
down like 20% or something, 17%, something like that.
Well, yeah, and against the euro, it's almost a 33% move, which is much more critical. I would argue is much more critical because the euro yen is indicative. You have to look at who do the Japanese really compete against in the trade world. It's not the United States. They compete against the Germans. They produce a high-priced, high-end product, better engineered. Look at the automobile. I always I couch in the terms of the Mercedes-Lexus spread, because they're both high-end luxury cars. And you see, as the yen was the strongest currency because it was a safe haven. And that cross, when I speak of that, I speak of the euro-yen cross, was down at 95 yen to the euro. Well, the Germans were able very successfully to steal, quote unquote steal, and I use that phrase, a lot of the luxury car, a lot of the automobile industry. You look to see that Volkswagen became the largest seller of automobiles. Now all of a sudden you're seeing the shift to Toyota. This is happening quickly. Everybody's talking about Toyota's profits are way up. It's a direct function of the euro-yen spread. So yes, the game is on, as we say.
Well, there's a lot of talk, and you said this on your blog too, in Notes from the Underground, that some people are questioning that this $85 billion open-ended QE, 0% interest rates, isn't just to get the economy going; it's really to devalue the dollar. I mean, aren't they really trying to devalue the U.S. dollar? Isn't that the game the Fed is playing? And they're like, oh, you want to devalue the dollar? Okay, well, we'll make this unlimited.
Well, and the Fed would tell you, and the Treasury would tell you, oh, no, that's not what. Well, let me tell you something. If you keep a zero interest rate policy while you run inflation of 1.8, 1.9, I'm using their numbers, 1.7, you have a negative real yield on your currency. That is a thing to put pressure.
Now, that's based on, and I just want to interrupt you, that's based on their phony, concocted numbers. People like John Williams says, well, depending on how you want to look at it, it's at least 5%, maybe as much as 9% inflation if you did it the way it was done in 1980 by the Bureau of Labor Statistics.
Well, I'll let them, but I'm going to use their numbers, and it's still a negative real yield, substantial negative yield on, especially on short-dated money. Look at the 2-year note is 29 basis points. So you're effectively losing 1.5% a year if you buy a 2-year Treasury note. The Japanese were a haven because they were the other way. They had zero interest rates, but they had deflation. So when you have deflation, even though interest rates are, you still have a positive yield. The United States has never had that. So I would argue that anybody from the Fed or the Treasury would tell me, well, it's not really about the currency. Yes, it's a currency because you will not allow deflation. That's been my argument about gold. People say gold goes up because of inflation. I said, no, gold goes up, and it has for the previous 10 years because of the fear of deflation.
Now, you made a prediction at the end of last year saying that gold will go up. You also said platinum would outperform gold. Well, they evidently had, this big HSBC thing, which the HSBC runs GLD. They got a $1.9 billion fine. Catherine Austin Fitts said, well, the overt part of the deal was the fine. The covert part of the deal was dumping gold onto the market and dropping the price down. So gold only had a 7% rise last year. But platinum, to your point, spread upward and, has a bigger spread than gold.
Well, we talked about that, I think, last time I was on with you, and that the metals market couldn't really get to its next bullish leg until platinum went back premium to gold, which we've seen in the last 6 weeks. We ended the year, platinum was $125 discount to gold, even at the end of the year, even though it had corrected. Now it's $60 premium. So I would argue that the next stage is set up for the metals rally, because that tells me not only is the automobile industry healthy, but that the Asians are back in buying precious metals. When platinum is performing so well, the Asians are definitely back in the precious metal market. So now we're set for the next stage. Now, I would also say, and I know we discussed part of it, is gold still a bull market? Absolutely. Is gold a tired bull for the moment? Absolutely. Because when you look at it, and I know you'll appreciate this, gold has done the heavy lifting for those who are looking for a safe haven status for the last 3 or 4 years. It's done yeoman's work against everything. Now, you've gotten some, you're in a position right now where the equity markets are performing. So if you had 20% of your assets in gold, you may say, you know what, I'm going to sell some of my gold off here, and I'm going to put it to work in the equity markets, maybe in some dividend. I can put it to work. I don't want to miss this entire thing. And I think that you're seeing that. Am I ready to forgo my entire safe haven? No, you'd be crazy too. There's so many variables of uncertainty, and I think that's the best way to refer to them, is variables of uncertainty that exist. Now, what do I think will be the most explosive event to take place for the gold? It is the day when Mario Draghi can no longer jawbone quantitative easing. He's actually going to have to step up to the plate and do an outright monetary transaction, or an OMT as they call it over in Europe. Right now, he's gotten away with not €1 being spent. And in fact, when we really look at how well the gold's actually held up here fairly better than expected, because you've had Europe go the other way. They've actually been reining in their quantitative easing program, which we call LITRO, which is the long-term refinance operation, which some banks actually paid down. So when Europe has to finally move to bail out the Spanish banks, and I'm willing to bet you before the year's out that there's going to be some Spanish bank that comes a-calling to the window. It'll probably take later in the year, because don't forget we have the German elections in September, and they're going to do all that they can to prevent any type of major blow-up in Europe, anything that they can, because that would sink Merkel.
Do you think? Go ahead.
And then we'd get into that situation. Because in Europe, the issue is, and you and I were talking, I know, before we started filming, is that what's going to take place in Europe? Well, what stands to take place in Europe is that all these current account deficit countries like Spain, like Italy, in order to keep their systems going, they're going to need a continual transference of money from the dominant locomotive of Europe, which is Germany. And are the German people, that was the problem going back 2 years. They started waking up to the fact of, hey, who's financing this entire game? And
Germany.
They looked at themselves and they said, us, and they weren't happy.
Not France, not Spain, not Portugal, not Ireland.
That's right.
Not Greece.
Right. And as Atmar Issing, who was at one time the president of the Bundesbank, or the chief economist for the Bundesbank, a very bright guy, as he wrote an article back in the FT about 4 or 5 months ago, and he criticized the whole thing because there was no, his words, not mine, as he said, there's no taxation without representation. And the German people were basically being taxed to pay for the rest of Europe, and nobody ever asked them.
That's right.
Nobody ever asked them. And I'll tell you what, it's interesting. Merkel has kind of started cozying up to Cameron from the UK here, and he was the guy who was always the odd man out. But Cameron's recent call to say that he's going to take the euro issue by 2017, which is after the next election cycle, he's going to go to referendum and finally ask the British people, do they want the euro or don't they want the euro? Now, everybody says that, that's a gambit and he's making a bad play. I'll tell you this. I'll be your only analyst who will tell you this. I think it's a brilliant maneuver, because if the Brits really go to a referendum, it's going to force the Germans to a referendum, because the German citizenry is going to go, wait a minute, they're being asked. Why aren't somebody asking us?
Right.
Now, that doesn't mean that it won't pass, but nobody's ever asked the people. Yeah, we know how they voted in the Bundestag, but nobody's ever asked the German people. And when they asked them in France, the vote was 50.2 to 49.8.
Wow.
Yeah. So
let's come back closer to home and let's talk about just finish up the currency war is in full bloom. They're not going to stop the currency war anytime soon, correct?
Yes, I agree. I think that's absolutely right.
So the gold play is nowhere near done until the currency war is done. Isn't that, you'd say that's an accurate assessment?
I would, but we'll go back to gold is a tired bull. And, and one of the things I told you, one of my big indicators were, of course, were the gold euro and the gold Swiss cross relate, as I call them, the crosses, which I think around last time they were hovering and holding the 200-day moving average, then they collapsed under the 200-day moving average, which has been very problematic for gold, because as we've seen, the euro's replaced the dollar, and I think this is Jim Sinclair's argument, is that the euro has replaced the dollar right now as a safe haven, because the ECB is not quantitative ease crazy. They did what they had to do, but they've gotten away with not really printing. A lot of talking, a lot of jawboning.
Well, they also had the currency, the swap lines open up from the Fed, which the Fed said, you don't have to print, we'll print for you, and nobody will know because we don't have to account for any of this. So, I mean, who knows what they've done with the swap lines over there in Europe? I mean, right now. But let's get back to the United States and the debt ceiling. The president is talking. He talked yesterday. I'm sure he's been sending signals about more taxes, about not cutting spending right now. The economy. We're always getting the same thing. And the Republicans are like, hey, you got your taxes. We want our cuts.
Right.
What happens if this doesn't play out? What happens if they, get into a situation where they just become at loggerheads? John Williams, the economist at shadowstats.com, says he thinks the dollar could fall apart, by as early as May because of this, budget battle. The S&P is being sued now by the government. They're the only rating agency that cut the America's credit rating. But Williams says the dollar could start circling the drain by maybe as early as May. The next deadline for the debt ceiling and to get, things taken care of.
Well, again, currencies are always relative. So I think 2013 is going to be a very difficult year because there are so many variables in play. Just what we're talking about now. Let's put a name to it, sequestration. That's a variable that's in play. And the Republicans have to ask themselves, this is an existential question for them. Because if they back off and they give the president, again, what is their purpose as a party? They have no purpose. I don't care about their gun control issues, and I don't care. Let's get down to fiscal responsibility. And if there's nobody going to be responsible, then you know what? I'm back to Nixon in 71. We're all Keynesians now, and you're living in the same la-la land that everybody else is. At some point, the Republican, it's incumbent upon them to make a stand. If they're not going to make a stand, it's absolutely going to be right.
And this is the stand that may happen. And another one of the variables that just happened this week, the underground nuclear test of North Korea, and then they're making all these machinations and all these comments about how their program is to strike the U.S. And that is awful incendiary.
Well, one thing about the North Koreans, and in fact we were just talking about it up here in the trading room, is that there's a G20 meeting and a G7 meeting. The Koreans are like a 4-year-old child. they have to remind the world that they're still here, so they throw a tantrum and say, we're still here because how are you going to buy us off? We have nothing, so we need fuel and we need food. We're still here, so as long as you're all meeting, give us our little piece because we play this game regularly. In fact, it's gotten a lot less attention than usual because, how many times can you keep going back to this well?
4-year-olds with nuclear weapons.
They're 4-year-olds. Well, listen, some 4-year-olds have guns, so it's not a pleasant situation.
And what do you think happens this year with the stock market? I mean, you were saying that it might sell off. I mean, it's what I see constantly on CNBC is $85 billion a month, 0% interest rates, and that's normal. That's how it should be. If you took away 0% interest rates and $85 billion a month, what would happen to the stock market?
Well, you can't just say that. If I took it away and we actually had real GDP growth of 5%, the stock market would initially go down, but then we'd want to buy it.
But I'm talking about how it is today, where we have just got negative 0.1% growth. All this money printing, we're still negative. What would happen to the stock market if they pulled the plug on the $85 billion a month?
There'd be a sizable correction. How sizable, I don't know, because people would be getting nervous. If you don't have the growth, if you pull it before you have growth, and I don't mean nominal GDP, I mean real growth, it changes the equation. If you do it beforehand, which is the argument, of course, of the Keynesian side, you're going to wind up getting yourself in serious trouble. Which, can they pull it? They won't. Because
no, they won't. But I guess that's what I'm talking about.
Yeah.
Well, I mean, it is a fantasy world. People act as if, $85 billion a month, $1 trillion a year, it's okay. 0%, zero cost of money, actually negative cost of money. And that's the way it really should be. Ira, I mean, this is a fantasy world, isn't it?
Greg, when I walk by the bank every morning to go up to my office, and I see 15-month CD, 0.85, 0.75, I click my heels and I go, yeah, yippee. But, so they force, Bernanke was as honest as he could be when he said back in Jackson Hole in 2010, in August of 2010, portfolio balance channel. Everybody should. That's what that means. I want to push you into the equity markets because I want you to take more risk. Everybody's taking more risk. People have gone into the bond market for God's sake. You know what? If at least in the equity market, I can justify my risk-reward basis. I cannot justify a risk-reward that I'm getting in the fixed income markets.
You're signing up to lose money.
Oh, yeah, believe me. And when I look to the upside, downside, because I know one thing. I can go to sleep at night and I know this. The Fed will not allow deflation. They've told you that, which is why I've always argued that the gold is, because when they tell you that they won't allow it, this is not Japan. If we went into a deflationary spiral, like we almost went into, we go to unemployment rates that this country politically cannot tolerate. Can't tolerate it. Because don't forget when Japan went into their deflationary spiral, yes, they had corporate debt, but Japanese citizens were not big debt takers. We live on debt in this society. Debt-based societies cannot absorb a deflationary spiral. Cannot do it.
So
not possible.
The money printing continues until it all blows up.
They're hoping. They think that they can buy the time to keep it from blowing up. Listen, the history of these situations is not good. They're just not good. History has shown us it's not the first time. We go back to the Romans. They had to deal. They clipped the edges of the coins. Where do we want to go? It's nothing. I'm a fan, and I read a lot of Fernand Braudel, who wrote about the 14th, 15th, and 16th centuries in the Mediterranean areas. These are the same things. Bad credit problems beget serious economic problems. That was the basis of the Austrian school of thought. You can't just be a Keynesian if you're not familiar with the Austrians. That's why everybody got themselves in trouble. I used to come on and say, in fact, I was on one time on Bloomberg, and I said, we're back in 2007, and I said, to paraphrase Nixon, we're all Austrians now, because if you don't understand credit cycles, you are way behind the curve, and there's way too many people who fail to understand the importance of credit cycles.
And one last thing, you wanted to promote a book that came out in 1995 that wrote a new foreword to it called The Rotten Heart of Europe. Why don't you hold it up here for us? And in a nutshell, because we're running out of time here, can you just tell us why somebody should read this book?
Greg, this is the most important book on Europe, on the euro currency, on global economics written, I believe, in the last 30 years. I've read this book 3 times. It's not an easy read, but it gives you, it's like going to a baseball game and not having a program. This book will tell you who the players are, they're still around, who's important to watch and who's important to listen to. Whether you agree with the outcome or not, you need to know who the players are and where they came from and that they're still on the scene. This Bernard Connolly is a brilliant man. You know, he's at all kinds of conferences. He is this is worth, and if you want to know about the Austrian school as much as the Keynesian school, this is a must read.
Okay.
And you have to order it through me because I believe this book is so important, Greg. I printed this and I'm not making a dime on this. This is totally out of friendship to Bernard, and he wrote the new foreword. There is no money to be made. You go to the Rotten Heart of Europe at gmail.com and you can order it and I'll send it to you. This is a family business.
Ira Harris of Notes from the Underground, a great analyst, legendary trader. Thank you for coming on USAWatchdog.com today.
Thanks, Greg. Pleasure.